If you've always wanted to learn options and it's just a little bit too much, a little bit too confusing, we've gone right back to the basics. We're talking about what is a call, what is a put, what's intrinsic, extrinsic value.
It's about how do you set up the building blocks of what good traders look like. So education around what makes a trader, as opposed to, hey, I think the DAX is going to go up or whatever. That's not useful. So this is fantastic.
So today we're looking at expiration and strike price. So we have covered a lot about the basics trading in the past 5 sessions. That includes the benefits of options versus stock, call options, put options, intrinsic, extrinsic, and moneyness, and then the latest one, buying and selling options, right? What's the difference between buying and selling? The previous topics could be understood without placing a trade, right? But now we'll delve deeper into options contracts and take a look into the specifics of trade entry. There's many different things traders consider when placing an options trade. The first two we'll look at being the expiration and the strike price.
In the trading and investments industry, the term expiration as a whole, it refers to the fact that certain trading instruments will only exist for a finite period of time. So for example, options, futures, and futures options only exist through their expiration date, after which the contracts are completely invalid. The term expiration date will refer to the calendar date and time in which a trading instrument stops trading, i.e. it expires. And after that, all contracts are exercised or become completely worthless. That means that when you're evaluating a potential options position, most investors and traders consider not only the price, but also time till expiration. The time until expiration within the world of options is the time is referred to as days to expiration, or DTE.
So, and a real quick cheat sheet is the monthly expiration is the 3rd Friday of every month, right? So that's really important. Get that into your mind also, because volatility tends to pick up around that day as well, because so many people have so many different strikes in their wheelhouse.
Yep.
So there we go. 3rd Friday of every month at 4 p.m. Eastern in the US. In the UK, it's 10:10. In Europe, it's 11. And I think the DAX is 12.
Yeah, it changes.
12 noon.
It changes.
So that provides a standard cycle for traders. If the 3rd Friday falls on the holiday, the expiration date instead will be the Thursday immediately prior, so the day before.
I think with all of these as well, just away from the script, on both the IG platform and on the Tasty platform, there is an info section that will explain the expiration, structures, how it works, all about your specific contract. So just looking there to kind of continue, the weekly options will expire in 1 or 5 weeks. We have introduced Thursdays and expiring 8 days later on a Friday. Like monthlies, they'll also expire at 4 p.m. Eastern Time, 9 o'clock our time UK, typically on Fridays or adjusted for holidays. Interestingly, the rise of 0 day to expiry options offer daily trades, popular for their speculation and protection for intraday or overnight moves.
Right, what is a leap? You'll hear people talking about this more and more. So that is options with longer than 1 year until expiration. They're generally referred to as leaps. Aside from possessing extended expiration dates, leaps are identical to regular options. The amount of option expirations available for a specific underlying depends on many factors, the most important being liquidity. And here is how you find it all, right? That is your daily expiration. You click on that button to sort between weeklies and monthlies.
Well, this is the S&P index futures, but if you look at something like SPY, I think they've got dailies going out to 2 weeks these days. So you can trade like 6 days, 7 days, 5 days, 13 days.
Yeah.
It's just that top part of your trader tab looks very congested. So the button in the top right hand corner allows you to get rid of all the non-regular expirations. Just click on the regular expirations and you'll get the end of months straight there for you.
So yeah, the closest one always at the top, going down to the leaps at the bottom. Right, XYZ days till expiration. When evaluating a potential options position, most investors and traders consider not only the price, but also days to expiry. Which one you choose depends on your specific strategy or your market outlook. For example, trying to capitalize on an immediate trend or holding out for longer term prospects, right? What's your actual view? If I just have a view on NVIDIA results, I'm going to choose this Friday. But if I think that NVIDIA over the long term starts to compress their margins and their earnings have peaked, then I'll want something more longer term. Extrinsic value goes down closer to expiry, and contracts that have a lot more time associated with them are going to be more expensive compared to contracts that expire in a few days.
Yeah, think about it like a voucher, is the way I've always liked to think about it. If I've given you a voucher that runs out of time tomorrow.
Where's it for? Denny's.
Pret.
Okay.
Okay, yeah, so if I give you a Pret voucher or if I give you a Thornton & Mason voucher, A, it's going to have different value anyway.
Yeah.
But if I said your Pret voucher expires tomorrow or in 3 weeks' time, what are you going to have? What do you consider as highly valued or more valued? And it'll be the one with longer time. So looking again at the platform, you can click on the strikes button on the left-hand side there to adjust the number of strikes that are going to be displayed. And the number of strikes will be an even number of puts and calls from the out the money, which is the yellow line through the center there. So the yellow line is the at the monies. Above and below, you see the different ones there. And the strike price is the price that we choose to take on intrinsic value for 100 shares of long or short stock, depending on the option type. Unlike stock, where we're forced to trade at the current price, with options, we can choose different option strike prices that are either above or below the current stock price. And what we choose will depend on our risk tolerance, which we're also going to discuss in future lessons.
And that's the bit that I love. It allows me to be a little bit wrong, but still make money from it. Right, now this is a beautiful slide. Take a screenshot because this puts everything into one visual, right? So we're where we choose to become long or short stock, right? That's your you see we go from left to right. The strike price is in the top left-hand corner, and then in the money versus out the money call at expiration. There's your 100 shares. Of course, if it's in the money, that's good. Then it's worthless. It disappears from the account. Or if you're short the call and you're in the money, you get the 100 shares of short stock.
Yeah. And what it also just describes here on the right-hand side is where the at the monies, that dot in the middle of it, your extrinsic value. If you're looking at the puts, your extrinsic value is higher the closer to the at the money strike level. That reduces the further you go down. And to the calls, your extrinsic value is going to go away, is going to disappear the further up the strikes you go. So the at the monies will have the most amount of extrinsic value. And again, they're on the bottom right-hand side. It's the same discussion, except instead of using calls, we're looking at puts. So a long put will expire worthless if it is out of the money, and a short put will also expire worthless out of the money, and in the money is the inverse.
Right, so what's our takeaways today, Luke Moore? Well, options allow us to choose different strike prices that can be above or below the current stock price. Different expirations allow us to have long or short-term assumptions of an underlying stock. And options that have longer expirations will have more extrinsic value than shorter-term expirations, giving them a higher premium value.
For puts, options below the strike price will be less valuable than options above the strike price, which makes sense. If you're selling puts, puts typically give you the right to sell. So therefore, if you're trying to sell above the stock price, that makes more sense, it's more valuable. Calls, options above the stock price are going to be less valuable than options below the stock price. Again, it makes sense. Calls give the holder the right to buy stock, so the cheaper the stock, the cheaper the strike price, the better for call holders, the more valuable they'll be.